Good morning, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing Podcast. I am your host, Real Estate Cody, and with me, as always, in the hot seat, Mr. Brian Alfaro, the coffee connoisseur himself. Good morning, my friend. How are you?
I'm doing well, Cody. How are you?
Fantastic. Excited to be back here at the mics, having another great conversation with a former friend of the show. We have another returning guest here today, so tell the audience who that is.
Yeah, if I'm not mistaken, we have Bruce returning from episode 37. Is that correct?
That is correct.
All
Episode
right.
Wow.
aired on October 7th, 2020.
Wow, we've all come a long way. So let me tell you a little bit about Bruce. Bruce is the founder, visionary, and owner of Bakerson. Growing up in the bakery business in the Twin Cities in Minnesota, Bruce wanted to pay homage to his now late father, hence the name Bakerson. After trying his hands in a few different ventures in Minnesota, Chicago, and Phoenix, he finally found his passion in real estate. He has a proven track record of success throughout Bakerson, nearly 18 years in the business with thousands of individual units bought, repositioned, and sold. Bruce has overseen all aspects of the business, including operations, acquisitions, project leadership, equity fund management, property-specific syndications, legal, finance, and more. His focus is finding good deals, while his passion is serving the residents by providing them with one of their basic human needs, shelter. Prior to launching Bakerson in 2002, he served as the acquisition team at a Phoenix-based real estate investment company. Bruce, welcome back to the show.
Hey, thanks. And the only update is it's nearly 20 years. The business was opened in October of 2002. And so it'll be 20 years now, this October, 20th anniversary.
Where does the time go?
Wow.
Yeah.
Wow. And you still look bright-eyed and bushy-tailed, young as ever, man. That's great. So, hey, Bruce, it's great to have you back, man. Really, really excited to have you here again. And, looking forward to kind of catching up since, like I said, October 2020 was when that episode 37 aired. And, I know last time you were on the show, we had a great conversation about, creating legacy wealth, really true legacy wealth. That was a great conversation. We talked a lot about focusing on the resident experience and how to nurture your residents and such. And so, we ton of nuggets in that episode, but, really looking forward to kind of getting caught up to what you've been having going on in your business the last year and a half. But before we do, I do have to mention, I know you're not in the baking business anymore or whatnot, but I haven't received any treats from Bakerson, man. I mean, I'm kind of disappointed, what's going on?
Oh, you got to come here to get them. My wife and I make cupcakes and wedding cakes. We do thousands of cupcakes a year out of our tiny little kitchen in our house. And so in fact, in a couple of weeks, we're doing another 350 for a wedding. So you just got to come to Phoenix and we'll cook you up some caramel rolls, some beautiful bundt cakes, delicious, and cupcakes. So we still do that on the side, but don't tell anybody.
All right, Brian. Well, we're making a trip to Phoenix to go visit Bruce and get some sweets. How about that?
Let's go.
Well, that's awesome, Bruce. Well, listen, man. Like I said, tell us what's been going on in the past year and a half over at Bakerson.
No, I'm glad you asked. This is we've had a heavy focus on the resident as we spoke, as you mentioned there, as we spoke on your last episode or my last episode, some 70 something episodes ago. But one of the things that we noticed is that the investors that we were taking care of really like to get in, get out real quick. And we're creating a legacy wealth that has shrunk our database of people that are interested in the longer term hold. But the good news is we've attracted some other investors who are very excited about our vision of the future and how we can protect capital in a changing market. And so one of the things that we're doing, which is very difficult right now, it's hard work, is to find properties where we can buy cash flow. The cap rates are so compressed. People are buying C properties at a sub 4, sometimes a no cap or a negative, with the plans being opportunistic and buying appreciation and hoping for the gains. And that works well until it doesn't. And so we're creating a future that's going to be protecting the investor as well as servicing the resident, just because when the market shifts, we want to still have cash flow. So how do you do that? And that's kind of the magic of what we're finding. But it's difficult. We've had to leave Phoenix market as far as purchasing. We bought one in Albuquerque and we're in contract in one in Fort Worth, Texas. So finding other markets where we can still buy cash flow. And the one we're landing in Fort Worth is quite amazing that we're getting, if it's a big enough market, enough crumbs will slide off the table to over 150 units. So it's going to be exciting.
Yeah, I'm really glad we're starting to show off for this topic, Bruce and Brian. I know we've been having this conversation over and over and over, and it's something that we believe in as well. As you're absolutely right. I mean, in this very aggressive market cycle, we've seen this complete compression of cap rates across all asset classes. You're not seeing really any major deltas in spreads between not only cap rates but even returns. I mean, the return metrics are almost similar across asset types, and the difference is you're absorbing a higher execution risk for more of these value add plays, just to really buy the opportunity to add value versus, just being able to get in and just operate efficiently. And so that comes with a high level of execution risk. And, I know that's been a fundamental shift for us in our business over the past, year and a half, 2 years, is really leaning more towards the core plus product. Because if you're going to pay a premium, you might as well buy the newer, better, more efficient property that doesn't have a lot of those execution risks that come along with it. But I'd love to kind of dive in more and get your thoughts on that. Like, I know you mentioned you were very heavily invested in Phoenix, and now you're kind of broadening your horizons to really find those opportunities that fit your investing thesis. Can we expand on that a little bit more?
Yeah. Okay. What we're seeing is that, like you said, the core and the core plus, we get that. We get why people are investing in that. And those are great business models, and it's really not our focus exactly. So right now, like I'll use Phoenix. Phoenix has made, international news as far as the growth rate that, we're seeing. The average property we see coming across our desk is between 250 to 280,000 per unit on a C-class property. And we're seeing A-class properties and more Metro A refurbished old buildings are getting some of the top dollar in Midtown or Central Phoenix and downtown. And we're seeing, $550 a door, 550,000 a door. And the inflation is obviously, is clearly kicking in, and the cost of materials is going up. There's a shortage of labor. There's a shortage of materials. There's the supply chain issues. I mean, there's so many challenges facing the new construction and also the other thing that we're facing is those people that are moving out of those areas where they're being gentrified, which I'm not against gentrification. I think it's a great business model. Again, it's just not ours. And so there's a class of people that we feel is very, very underserved, and that's the lower middle class and the upper lower class. And the reason that I feel that way is they're typically not homeowners, or often not homeowners. Statistically, they're not, and they are self-paying residents. They're working at the local, local retail. They could be managers at retail stores. But they're self-paying. These are not the subsidized government housing. And again, government housing is another option. It's another opportunity. It's a growing class. It's a good opportunity. And again, it's a good business model. It's just not our business model. So above the subsidized, the ones on voucher programs, and then below the homeowner, it feels to me to be a significantly growing demographic, and the rents are far outstripping their income. The rents are getting really, really expensive for them. And so we say, if we can find cash flow and buy cash flow and supply units to this market, that's a little bit that we can do in the markets that we work in. And it takes care of the residents, takes care of the investors, and lastly, it takes care of us at Bakerson.
Yeah, I like that. But, Bruce, to that point, are you concerned that, the lower income or lower middle class demographic is being eliminated or priced out of today's marketplace? I mean, you're seeing this, what appears to be massive, shift of wealth and deviation, of the middle class, where richer getting richer, poor getting poorer. We've heard that, that's kind of a saying that's been floating around for forever now. But I mean, I think really right now is you're seeing that evident, right? You're seeing home price valuations that are just skyrocketing. We're seeing inflation that's just negatively impacting, the majority of Americans. And then now you've got, rent inflation, things like that are affecting us on the commercial side. So, I mean, all of these different factors that are really impacting that lower income, that middle class demographic. Are you concerned that they're getting priced out and squeezed too much in this market cycle?
Well, they will in any cycle. And there's two things I want to address on that. Number one is, if you look at the cost of materials goes up, right? So the cost of materials, we know lumber and electric. I mean, aluminum, you name it, aluminum windows are almost impossible to find right now. People are a year out getting their windows for their homes. So there's supply chain issues. There's also price increases with inflation. Lumber is very expensive right now. And so the builders are charging that ultimately by raising, they're raising the rents, and they're getting the rents for those people that can afford it. And so you have to cover that. So first the inflation, first the cost of materials goes up, then the cost of living goes up. And the last thing to rise is to move up is the wages. Wages don't, like, gas prices went up overnight. Wages aren't going to increase overnight. And so the impact that I see is first the cost of materials goes up, then the cost of living goes up, and then the income catches up in this part of the cycle. And then that'll equalize over time. But in that time period where it's not equalized is a very difficult time for people. And when they lose something very simple, it's a 4-letter word, it's hope. When they lose hope, it's a very difficult time because they think this is going to last forever. Most people don't think beyond the next paycheck. They don't have a vision of where they're going to be in 3 years, 5 years, 10 years. They don't have that vision. They look at, hey, it's Wednesday or today's Thursday. Tomorrow's payday. And I got a bill that's due. They borrow, they go to pay one of those check advance companies, get an advance on their paycheck to pay a bill today because they're getting paid tomorrow. They think this is only going to get worse, and it's going to always be that way. Why? Because that's just, it's human nature, perhaps. I'm not a psychologist on that side, but that's what I see in the market. So during this time, then it'll equalize, wages will start to come up. We see the minimum wage in Albuquerque is going to be over $12 an hour. It was $9 an hour for a long time. So as those wages are forced up by government, brought up by, I just heard that In-N-Out Burger, you can make $20 an hour working there. And so the wages are going up, but they don't go up as fast as inflation. When inflation stops, or the rate increase, the increase slows down, then the wages catch up. Then people have a simple life like we did for a number of years earlier in this cycle. The second thing to think about, and very few people have, I think, thought about, is if I live, let's say I work in downtown Phoenix and I'm renting in downtown Phoenix. Now the rents went from $800 a few years ago to $1,400. There's no way I can afford that extra $600. So I go further out into the suburbs. Now gas prices went from $2.85 a gallon to $4.85 a gallon. That's eating it up. They're like, I'm done. I'm not working downtown. I'm going to work out here in the suburbs, in Goodyear or Litchfield Park, or some of the other areas that are less expensive to live in. And there's jobs available. There's job growth. So people are having a difficult time living in the neighborhoods they work. And the gas prices, I believe the cost of commute will start to hit their pocketbook. I've heard it from people that I work closely with, that, it's so many dollars per mile that they, so many dollars per mile that they have to drive. And they mapped it out, and they said, it's expensive for me to commute to work. I'm like, wow, I never even thought of that, because it hasn't been an impact on my bottom line as much as theirs, because the prices went up equally, right? If you're making $100,000 a year, you're making $10,000 a year, your gas prices went up equally. And that hits the people on fixed income and the lower class the hardest. I was just visiting, my mom's retired, lives in an apartment on my house, and we were visiting yesterday over coffee, and she says, I have to kind of consider that. Where do I drive now? She's 77. She says she's not going to drive as much, because she says it's so expensive for me to drive. She says, I have the same income I had last year, but my cost of living is going up. So she's concerned about that. So if she is, I know there's a lot of other people that are concerned. So those are the things that are, when I say they're outstripping, they absolutely are in Phoenix and Tucson for sure. We're still seeing opportunities, like I said, in Dallas and in Albuquerque. Dallas is such a huge, I was shocked when I was there. 7.8 million people at Metroplex. That's incredibly huge. So there's opportunities. It's different. It's not as small as the Phoenix or Tucson markets or Albuquerque, Salt Lake City.
Yeah, and not to downplay, the impact on, again, that lower income demographic that we're discussing. It's taking a toll on a lot of Americans right now, and it's definitely, and there is a very big need in the multifamily space, right, where there is such a lack of really true affordable housing that's available to the residents, and it's really posing a significant housing challenge. So kudos to those, individuals that are out there trying to solve that problem. But, in looking at markets like Phoenix, Tucson, you mentioned Dallas, all of those markets are experiencing just robust, net in migratory patterns, right? You're seeing an influx of new residents coming in from other states, especially the West Coast, whatnot. obviously that's fueling a lot of the demand and the supply shortage that you probably are experiencing there. Are you considering that when you're looking at, expanding your horizons, going to other markets that are experiencing the same type of growth?
Not necessarily. I haven't looked at it quite that way. I look more for the stability of the market. Like where will it be long term? And I'm a little concerned because Phoenix historically has been so boom and bust. I mean, you look at it's been like that forever. I know people that were here in the 90s, and one guy had his house on the market for a number of years before it sold. I had it rented out during that time in the 90s. So there's been the booms and busts here. And I'm hearing so many times, oh, Bruce, this time it's different. These are the metrics. I'm like, man, these are the same words I heard in 2004 and 2005. Oh, this time is different. In fact, I said those words. I lived those words. And in 2010, I started all over because our land deals just went, we really got hammered, and I lost a lot of money, and I started over. So I know what it's like to live through that. And it could be very well that we don't get hit as hard here, because for the first time in the history of the state, number one industry is manufacturing. It's usually been, the seeds, the copper, the citrus, and climate. And so there's different things that were the driving factors here. Now manufacturing is number one. Governor Ducey just mentioned that end of last year. And I'm like, well, that's pretty amazing. So it could be different. Dallas didn't get hit as hard in the last cycle as Phoenix, Vegas, and Florida, as much as we did. But nonetheless, you want to prepare for it. But it feels like the growth, the prices are outstripping the market. It just feels like that. And so I want to be cautious. And if I'm wrong, I can still protect the investor. Because let's say we gamble, wrong term, but if we build a 10-year model and we say, this is what it's going to be over the next 10 years, and we protect ourselves from a falling market, let's say in 4 years, and it doesn't, we're still in a better position. Why? Because we had a cash flowing property when we bought it, and it's still cash flowing, so it's still safe. If you protect for the downs, you're still good in the ups. What I don't want is to have a model that says it's a 3-year model, we're selling in 36 months in any of those markets. I think we're all going to get 3 years from now, it could be pretty dicey. It's who knows for sure, but I don't want to be in a position where we have to sell, and as the market is going soft, you're chasing that sale date. I've done that before, and it's not fun. In 2009 and 10, it was a very difficult time for me.
Brian, Bruce brings up a lot of great points here, and I know this is conversations we're always having on a daily basis. It seems like internally. What are you thinking back there?
No, you're right. This is stuff we are talking about daily. I like the idea of being flexible with the long-term hold, right? Where a lot of investors are trained, as we'll use that term, on the 18, 24, 36 months. Cody, you were a passive investor in a deal that you doubled your money in 24 or 28 months or something like that, right? And that's great, but the music stops at some point, right? And you have to be prepared for those potential corrections or downturns or whatever you want to call them. And the idea of a longer term hold is something that we've been saying internally, especially to our investors. Like, look, of course, we're going to underwrite on a 5-year plan, but there's a chance that a 7 or 10-year hold might be in play. And that's a way where, as long as Bruce is saying, is you've got some stable cash flow, you can weather those downturns. Now, you might not be cash flowing as well, but you're still not going into foreclosure. You're not having trouble, paying your debt, and your investors are still making a little bit of money. And we can sort of ride out this correction. And then when the market's on the way on the up and up, then we can look at potentially exiting. So I like the business plan that Bruce is implementing here. And he mentioned also that he's pivoting his investor base as well, right? He talked about how he's had to fill his pipeline with investors that align with that investing thesis, which I think is important for our active investors and our passive investors, just to make sure that you're aligning with a sponsor that that reflects your investing thesis. If you're looking for quick flips and quick opportunities, Bruce is not the guy for you, right? But if you're looking for if you're looking for an opportunity where you can build wealth long term, and you want to park your money and you're okay leaving it in 5, 7, 10 years, then he's the operator for you. So I think knowing your investing thesis before you get into these opportunities, whether you're active or passive, is really important.
Thank you for that. The one thing I wanted to address on that, you had mentioned the longer term hold. I've had numerous conversations of people, probably a handful, less than 5, but in the last month or so, after the first of the year, there's some limited partners, some investors that have been in deals, and one guy says, hey, he's getting his money out, and it was supposed to be a 36-month project, and they're getting out in, I think, in like 18 or 19 months, and they're getting out in April. He says, that's exciting. We got a really good return. He says, but now I got to find another place for it. And I was looking online, and he said, man, there's just way too many things to look at. He's a full-time job in manufacturing in the Midwest. And he says, I just don't have time. I'd rather make a little less money and not have to worry about it. And I thought that was interesting. And then another guy on LinkedIn who also does podcasts, we had to exchange on LinkedIn, ended up getting on a Zoom call just one-on-one. And he said the same thing. He's an active investor, but he also does passive. And he says the passive ones are, he said, when they're in and out quick, he says that sure, it looks good and it's exciting, but now what? And so now there's two things I think you consider is if you're in a deal that's longer term and there's ups and downs in markets, and you just ignore that and just cash flow your deal and get good returns, get 10, 11, 12% cash on cash, 15, 18% IRR, over the life of the project, that's a good place to be. And then, but if you get out early and you have this cash, now an investor gets out, let's say they sell, and then the market starts to go down. So they hold on to the cash. The investor's in a very good spot. But what about the operator? The operator can't buy any deals, has no cash flow. What's he going to do? It's a very difficult time. So we have to have a focus on the operators, but we still need to take care of the home team. That how can the operators be in business long term? How can they stay through these cycles? Well, if I sell everything, and sure, I'd get some cash, but if you're not buying anything, if your sole income is from buying and selling properties, if you're not buying, eventually you're going to run out of cash. That well is going to go dry. So that's why I like the idea. And there's nothing wrong with, we may still do some short-term buy, fix, and sell, but there's two scenarios that leave the operator either without opportunity, or the investor is losing money on his investment and panicking and pushing that button, sell, and then forces an operator to sell. That'd be a difficult scenario too. But if you have that longer term, and then you could have that conversation in year 7, say, listen, the market's good to sell. If we sell, we can trade up into this other asset. It's still good market, or we can hold. So we'll look at that. The 10-year isn't ambiguous. It's just a number. It means, it could be year 7, it could be 13, it could be year 30. Who knows? But we're modeling on a 10-year.
Bruce, you brought up a really, really, really good point there just a second ago about, making sure that the operator can sustain and be in business long term. And you're absolutely right. I mean, we're in this market cycle now where there's too much liquidity chasing too few deals, right? And that is definitely a proponent of or are creating this byproduct of demand and what we're seeing in this asset value inflation, right? And it's forcing people to either buy too aggressively or buy assets that probably, they shouldn't have been even considering at the time, because they, like you said, they're just trying to find something to kind of keep sustaining and stay in business. But to the point of these longer term holds, I think we're entering this period, and we've talked about this at length before, right, Brian, where operators today are going to have to accept the fact that I think they're going to be forced to hold for longer term. This idea of flipping properties in 24, 36 months, I think we're going to discover very quickly is probably not going to play out as frequently as what we've seen over the past, decade, and particularly the last 5 years or so. And you take into account like what are we experiencing right now? We have a European conflict that is yet to be determined as far as how high that's going to escalate and how that will indirectly or directly impact us at the, as a U.S. economy. We have a 10-year yield curve that's on the brink of becoming inverted. The 2-year and the 10-year spread is, I think, a difference of 25 bips the last time we looked at it the other day, which historically would prove that once you go to an inverted yield curve, you're entering into a recession type of environment. And so there's a lot of factors that are really kind of creating this scenario of unknowns economically right now for us. And I think ultimately that's going to drive people to really hold these assets longer term. And so I know that's well suited for your model, but operators need to be prepared for that.
I had right before the call, this recording, I had a call with my son, and I were visiting with some investors out of Europe, and they introduced something I never thought of. They said there's two things. Number one is you got to look at what is the exchange rate of the euro versus the dollar to see if the U.S. is a good investment. That's one thing that you just don't think about. That they say, well, it's a good time. Well, right now the dollar is pretty strong against the euro, and then now there's this the battle of Ukraine, and Russia's rattling its sabers over there and doing more than that. They're dropping bombs on Ukraine, and And there's other countries around there, that Finland, Sweden, that are concerned about where is this going to go and will this impact us? And they're thinking, hey, we should probably in the next year or two put our money outside of Europe until this stabilizes, because the chance of, let's say, Dallas or Kansas or interior city going into war in the United States, that we have a pretty big military here, that chances are it's not going to be brought to our shores at least too deep. So they feel it's a good place to put money. Never dawned to me. You're pretty focused on what's going on in the United States and how can we protect ourselves. But they're like, there's high net worth, wealthy Europeans that need a place to put their money, and they feel right now that America is safe, that they're going to bet on the military, that they will stabilize the world economies. And although I don't like to be the world's policeman, I think it's an unfortunate thing as an American, but the reality is we have 300 military bases in 147 countries. We have a presence, and because we have that now, they give us the responsibility to help them. But the chance of it coming to our shores is small. Now, can it? Absolutely. The rockets can reach here. We know that. But historically, it's been a safer place than perhaps in their own hometown.
Sure.
Never even dawned on me. It's a whole other topic that it might be an interesting one to attract international investors. That what do they think? I told those guys, okay, you guys deal with that. We'll deal with the local, what we do here, and you guys work with your investors on that, and together we can put some deals together. But they might bring some capital into us, and that it's interesting. The world economy is really, really fascinating to me.
It really is. And I think it's something that every investor should really try to understand, even at a base level, not necessarily that we'll be experts on the global stage, but it's definitely something that's important for people to have a fundamental understanding. And I know, I definitely believe, Brian, you do as well, right? You don't ever bet against the USA. Don't ever bet against the US economy. I think, I definitely think that regardless of whatever situation we're in right now, I still think that we have a bright future ahead of us, bright forecast, and multifamily particularly is going to perform very well. But I want to go back to Bruce, your strategy, especially this legacy wealth strategy, looking at these longer term holds, aside from just modeling out a 10-year hold, for example, what other ways are you hedging against your downside that you alluded to earlier? What are some other things that you're incorporating to hedge against that downside in addition to that longer term hold?
But what we're wanting to do is, like, right now, you can get some pretty good debt. You can get 80%, loan to purchase, and a bridge loan. You can even get 100% of repairs. And sure, that looks good as long as the value that you receive at the end of your project, the stabilization portion, is no more than, then your debt becomes no more than 65 to 70%. And 65 would be really good if we could keep our debt on a stabilized asset under 65% of value, not of purchase and repairs, but of actual value based on actual NOI, not pro forma numbers. I'm talking real numbers. If you could be at that 65, maybe even 70%, then you're going into this cycle much safer than you were if you're stuck at the 80%. Now, I know some of the longer term debt you probably can't lock in 80%, but just be cautious on that. And my mentor that I've been working with quite a bit has had experience in real estate and multifamily for 53 years, and that's how old I am. So I'm thinking he's got that many years experience, and he says that he never leverages more than 65% of stabilized asset. That's what he leverages. And he made it through the last cycle, 53 years. He's been through 5, 6, 7, I don't know how many cycles there is in 50 years. That's a lot. It's more than one. And they've weathered it fine, and they do legacy hold. In fact, they had a fund that was set to be closed, a 10-year fund that was set to be closed in last summer, and unanimously that all the investors said, leave the money in there. Let's continue this for another 10 years and go buy and sell some more assets within the fund, but keep the fund alive. So I'm thinking, well, maybe he knows something more than I do. He knows something more than the syndicator that started in 2019. Nothing wrong with that person, but listen to those that have walked the roads before us. And to me, those are two things: is limited leverage, and talk to those that have been down these roads before and listen to them and follow their lead, because they haven't been in business for 53 years because they made a bunch of bad mistakes. They made a lot of good decisions.
Yeah, Brian, I think is it Bill Helm that mentioned this, right? Like, if you look at historical cycles and different trends, I mean, like you look at our circumstance now that we're in, and it feels like, oh, it's the first time we've ever experienced this, or oh, it's a new circumstance, and oh, this time it's different, right? Bruce, you alluded to that, but I think our friend Bill Ham mentioned that, look, history repeats itself. Like what we're seeing now historically or versus trends, or it's not different from what prior cycles have experienced before. It's maybe the circumstance is different, but history tends to repeat itself over and over and over. And so I think to your point, I mean, look, somebody that's been in business for 50 plus years, they've seen this time and time again, right? They know how to prepare it. And you're right. And we've heard from other industry leaders that very similar to your mentor, that, guys that have billion-dollar portfolios that are levered 55, 60%. And, that's the key to their success. At 55, 60% leverage, you can weather a lot of storms or downturns. You can weather a lot of circumstances and still feel pretty good about sleeping at night. I don't, Brian, what are your thoughts there?
No, I agree. These industry professionals that have been in the business a long time, that we all kind of aspire to be getting started in the real estate space. There's a reason they've been in the game so long and they haven't fizzled out. And it's looking at these nuggets. Cody always say success leaves clues, right? This is one of the clues that they're leaving for us, is just making sure you're being careful about the amount of leverage you're taking on any investment opportunity, whether it's multifamily, single family, industrial. It doesn't really matter what the asset class is. You have to be able to weather any particular storm. And that lower leverage point is really one of the main driving factors of that. Being a good operator is another one. Make sure you have a good executable business plan. There's a lot of variables, but that leverage is really important, and looking up to those that inspire us and can have built the path thus for us is a great way to don't reinvent the wheel, is what we like to say. It's a great way to be successful in this business.
Yeah, well said.
I'm a firm believer in the land 18-year land cycle, and people might think I'm out in left field, which is fine because there's activity out in left field too. We need a left fielder. But but anyway, if you look at the 14 years up and 4 years down is something that has been consistent for 200 years outside of the World War II and the Korean War. Otherwise, it's been 14 years up, 4 years down. So if you use that model, or you have that, if you buy into that, 14 years up would be somewhere around 2020. The bottom was 2011, 2012 was probably about the bottom. And so if you go 14 years up from there, it's 2025, 2026. And then it'll go down to 2029, 2030, and then go up for the next 14 years. And it has been consistent, the land cycle in real estate, what drives the values. And I know some people don't believe in it. And I wasn't even going to bring it up here because people say, oh, it's not that. Well, maybe it is. Read the Secret Life of Real Estate and Banking. It's a very thick, very deep book on the history of land cycles in the United States for over 200 years. And it follows that very consistently. Now, you can't predict what causes it, but you can predict it will happen. Does that make sense? Like, we don't know what's going to cause that catalyst. Last time it was over leveraged houses, and people are like, oh, yeah, this time we don't have that problem. We don't have these subprime mortgages. Well, it's not going to be subprime mortgages every time. We'd be fools to make the same mistakes. It'll be a different mistake. It'll be a different economy, different thing. Who knows what it will be? I don't know what that will be, and I don't have that crystal ball. But I'm going to prepare myself. And then if I'm wrong, guess what? I still have a very safe investment. If it goes up and I'm under levered, that's good. If it goes down and I'm under levered, it's good. It just feels so safe, and it feels like a much better model than let's always bet on it going up, because the time it goes down, the equity is gone first. I don't know. You look at the model, right? If the prices go down, equity goes first. The lender's not going to say, oh, your value went down. Sure, you can keep your equity. I'll drop my loan. Has that ever happened? No. That's why they have lower interest, and they do a background check on the sponsors, because they're the ones that are the most secure after the city and state property taxes, of course.
Yeah, that's great points there, Bruce. And speaking of this, I want to kind of make a pivot, but kind of keep on the same topic here. As you mentioned, finding investors that realize that and really see that as long-term wealth strategies, right? Long-term wealth preservation. There's more of a niche set of investors, I would think that way, or really, look at their portfolio that way. What's the message or what's the expectations that you're seeing across your investor avatar now in attracting those type of investors? How are you navigating those conversations? How are you finding those investors? I guess more so, what type of investors are you seeing that have that particular same thesis or vision that you do?
Okay, I can answer the last question. The other ones were a little bit not as clear for me in my mind. They're good questions, but I didn't have an answer. But the last one is, the people that we're really attracting and talking to primarily are individuals who made their money outside of real estate. There's a doctor, a surgeon that I've talked to. There's another doctor here in the Phoenix Metro that served in the military, and then he's retired from that. Now he's a doctor at a medical center, and his circle, they don't know a lot about real estate, but they know that it's a good place to invest, and they don't want to keep moving their money. They're busy in their careers. Their careers are very demanding. There's a guy in Midwest that I mentioned earlier is in manufacturing. There's another one that's in distribution. They have a career that's very, very lucrative. They're making, $200,000, $300,000, $400,000 a year at the top of their top income people, but they don't have time to analyze a lot of deals. They want to find a sponsor who they can get involved with and follow that, but they don't have time to get their money back and go redeploy it. They used to be in stocks, maybe a lot of them were in the stock market, and they're uncertain of where the stock market's going because there's a lot of uncertainty out there. And they say, hey, if we go with a sponsor who can influence the value, that'd be kind of fun, and they can see the impact it has on the neighborhoods. And that's another thing that people want is people have become, especially the younger, successful investors, are more altruistic. They want to make a difference in what they're doing. They want to have an impact. They've seen that previous generations were pretty self-focused, and they did, but then when they're young and then when they get older, they're like, okay, now I've been successful. Let me see what I can do to help others. Let me see what I can do to give back. And millennials, as much as people make fun of them, millennials are the ones that are successful, accredited investors are fantastic for impacts from they want to make a difference right away and make a good income doing it. And so that's another niche that we've talked to, but primarily they're individuals that are a little bit older, my age, 50s and up, where they have a really good career and they want to get into real estate, but they don't have time to do to run the projects or do it themselves. And they've made their money outside of real estate are the best investors. The one making money in real estate are active. They're difficult because they do want to get out 3 to 5 years. And, some of the equity funds are the same way.
Yeah, I appreciate you speaking to that. And I think that's kind of where I was hoping we were going to go with this, because Brian and I think, for our business are looking at something very similar where we use the term, and this is not to offend anybody, but more sophisticated capital. And what we mean by that is investors who aren't looking for an immediate return, or investors who aren't dependent on just the real estate income to meet their income needs, right? When you have investors that, like you said, have built their wealth in other streams of income, whether it be their investment portfolio as a whole, or maybe it's been their W-2, people that are just looking for a tool to diversify their portfolio, but not necessarily just trying to rely or be dependent on only real estate to produce whatever their lifestyle income needs to be or whatnot.
Yes.
And I think that's important because we all know that wealth in real estate is built long-term, right? Trading deals hand over hand. Okay. Yeah. You can make a lot of money short-term and through transactions, but really where you want to build and preserve your wealth is that long-term strategy, and having investors, like you mentioned, that they don't need the income from real estate to sustain a lifestyle, but they need it to protect their long-term wealth. That's the fundamental shift that, we've made in our business. And I think I encourage other investors listening to today's episode, really start thinking about as well, as the long-term vision. Brian, any thoughts there?
No, you hit the nail on the head, Cody. I think understanding that real estate is not a get-rich-quick scheme, no matter what part of the cycle you're in, or build wealth quick, I should say. You can, depending on your cycle, have some good opportunities to get in and out of deals, as we've kind of alluded to throughout the show. But as Bruce said earlier, you're making a job for yourself. If you invest in a deal and you need to repurpose that money, put it back to work in 18 or 24 months, you're not really building wealth. You're like flipping houses. You're getting some quick hits of some capital back, but you're not really, helping your cause of building that long-term wealth, enjoying the tax benefits. And at that point, you have to ask yourself, are you really passive as well? Right. So I think thinking about building wealth long-term, looking at these long-term holds and having that mindset shift that cash flow is important. Everybody wants cash flow. We've talked about buying cash flowing properties to protect your downside. But at the same time, you're looking at it from a little bit of a different vision that, we're trying to align with that investing thesis that you don't necessarily need the cash flow to sustain that lifestyle. That's definitely something we've pivoted to. Bruce has pivoted to. We would encourage our other active investors to look at as well, and our passive investors to think about that as well.
Mm-hmm. Ryan, you made a point that just triggered a conversation I had with an investor. He had it's been 2 months since he's got his money back on a project. He got it back in January, and so it's 2 full months of his money hasn't been working. It's sitting in the bank, and so he found a deal that he invested in, and they're closing in 90 days. And now he's got 5 months where they're not closing for 90 days. So his money won't go to work until closing. So he's got 5 months of zero return. So if it was 18 months, I don't remember how long his investment was. Maybe he didn't even say, but let's say it was 18 months. He really has to look at that. That became a 23-month investment. So he might've got a 20% or 25% return, but for 5 months, he's getting zero. And that's what people don't think about. When you redeploy, it's not like you close it on Friday and reinvest on Monday. If you're doing that full time, sure, you'll be ready for that. You're prepared for that. But if you're not, if you got a full-time gig somewhere and this is a side, this is your investment side, you don't want that. So it is attracting those. I know it is a smaller demographic that wants to be in that position, but that's okay. And then you had mentioned, Cody, about transactional. I look at this as transactional versus annuity. If you know annuities, they get paid out over time and it's a long-term investment. Transactional is you go to the store, you buy or somebody comes to your store, they buy something, they leave, you made money. But how do you get repeat business? How do you get repeat income? How do you get annuities? How do you get it to be no longer transactional? Even if you're in a 3-year buy, fix, and sell, that in a lifetime, that's transactional. That is not an annuity.
Yeah, completely agree. And that's why I think, we're very much in line. Yeah, I think with your thesis as well. And we do the same, right? Where our business models are modeled on a 5-year hold. But look, internally, we'd absolutely love to be in a position where you're holding buildings for 10 years, again, because that's where your wealth is created. And we don't want to be transactional, turning properties every 24, 36 months. Yeah, it's great in the short term, but like I said, you don't want to keep running into the problem of having to go find the next one, having to go find the next one, having to go find the next one. And more operators that we're talking to now, like yourself, that have, long sustaining portfolios, they're all saying the same thing. They don't want to sell right now. Nobody wants to sell. They just want to hold and just continue to reap the benefits of having hard assets, especially in this type of environment. So I think you bring up a lot of great points there, Bruce. And, I definitely think we'd agree with that thesis for sure. So, and again, that's why it goes back to our very first conversation we had where, you're really building a business that produces legacy wealth. And you hear that term often, but you really, truly incorporate that into your business model in creating that legacy wealth for you and your passive investors. So I always like to give you kudos for that. So
thank you.
Absolutely. Well, Bruce, we're kind of getting there in the end of our time here. I apologize. Man, I'm stumbling, Brian, today. I don't know. My lips keep getting stuck, but always great to spend time with you, Bruce. But Brian, anything to bring up or anything that we didn't discuss with Bruce before we get to our final four here?
No, really appreciate Bruce being on the show. I know last time we talked about the resident experience, which is obviously really important if you're an active or passive investor, making sure the operator understands the importance of this. But I think right now where we're at in the cycle, what's going on in the world, this has been a great conversation to highlight some of the important factors that everyone needs to be considering going into future real estate investments and sort of the mindset shift as well that we all need to be having, because real estate is cyclical. And if you're not adapting, then you're probably dying because the business is constantly changing. And all the points that we've made today are just great nuggets for everybody to definitely stay in tune with and to definitely another motivating reason to reach out to somebody like Bruce as well.
Absolutely agree, man. Absolutely agree. All right, Bruce. Well, let's get to our final four here, man. And we had a similar series of questions for you last time, but just to revisit that, what do you like to do for your continued education to further your investing?
11531. Each quarter, I set up a plan, and number one is to set a goal. Number two is a skill needed to reach that goal. Number three is to read 5 books in that quarter, and then the next number is the number 3. That's 3 audiobooks, and then the last one is a 1 that's to find a mentor, somebody that's been down that path before that I can tap into for experience. So that's what I'm doing now. And my current one is making impactful presentations. That's first quarter this year, which comes that training is ending here at the end of March.
Love it, man. That's awesome. You spit that off really eloquently. 111531. I'm gonna have to remember that one.
11531. Yeah.
Love it. Love it. Well, Bruce, looking back in your business, in the timeline of your business, what was that one moment of time or defining event that really changed the course of your business?
Well, the biggest event was when the market crashed in 2000, 2007, 8, 9, 10, 11, 12, that down cycle when we were chasing smoke, and it was really difficult. And we basically lost everything but our dignity because we were heavily leveraged in land, and land plummeted in value here. It wasn't even worth the property taxes owed in some instances. And what I learned from that is to really prepare yourself for the future. So if you hear me really speaking to that, prepare, it's not, I'm not a Debbie Downer. I'm not Debbie. I'm not a Donnie Downer. I'm not saying it's going to be that way for sure or when, but when it is, be prepared. That's all. And be optimistic, but still be prepared for the downturns. You can be optimistic. If the world around you is crashing, you still be optimistic and hopeful for the future beyond that. So you have to look beyond tomorrow, beyond next year.
Yeah, I think that's great. And that was going to kind of answer my next question for you, but any other advice aside from that you'd give to the listeners to help them grow their businesses?
Be an avid reader. Last year, my goal was to read 52 books in 52 weeks. And I think I hit 44, but I'm on book number 9 this year. So I'm on track. And I met a guy skiing in Snowmass a couple of weeks ago, and he wrote the book Blind Ambition, Chad E. Foster. And now we've been connected on LinkedIn. And I listened to the audiobook, and now I'm reading the book, and it's phenomenal. Here's a guy that's blind. And what does he say? He says, I am blind so I can help others see their potential.
Oh, wow.
And it's amazing what he's done. It's an awesome story. So read success stories of those that have had disadvantages, because you find out that those of us that don't have those physical disadvantages, the disadvantage we have is the man in the mirror.
Ooh, that's a good one. What a great way to end the show there. That's great advice, Bruce. I appreciate it. Brian, we're going to have to add that one to our reading list too. So
love it.
Awesome. All right, Bruce, we'll tell the listeners how they can learn more about you and Bakerson and get connected with you.
Well, you can go to our website, bakerson.com, bakerson.com, because I'm an SOB. I'm a son of a baker. And you can reach me by phone, 520-808-9111. And people do call me, and I encourage that. And then email bruce@bakerson.com.
Well, Bruce, I always appreciate the opportunity to connect, man. Really appreciate you tuning in with us today, and look forward to the next one.
Thanks, Bruce.
Sounds good. Thanks a lot, Cody. Thanks, Brian. I really appreciate being on your show. You guys are awesome.
Thanks, man.
Thank you.